Hey guys, it is Julie here with JT Wealth. In today's video, we're taking a look at 3 stocks that look like good buying opportunities after their recent dips in price. So let's get into it. All right, guys, welcome back and thank you so much for being here. Like I said, today we are taking a look at 3 stocks that analysts say to buy the dip. We're going to take a look at each of these companies and what it is that they do, plus what analysts are predicting for their stock's future. And just before we get into that, this is your friendly reminder that if you enjoy today's video, make sure you hit that thumbs up button and leave your thoughts in the comments down below. Also, don't forget to head over to the TipRanks YouTube channel, where you can catch my daily pre-market update, where we're giving you everything you need to know before the opening bell. I am there Monday through Friday, so make sure to head on over. All right, now this first company we're going to take a look at is one that I've actually spoken about several times before since last summer as a great growth stock, and that is Teladoc. They trade under the ticker TDOC and are currently priced at about $186 per share. Now, they did see some great growth, especially December through to February, but then in February into March, as most of the market, they have seen quite the dip in price. Now, Teladoc is basically a virtual health company. They get you the right care when you need it most, and you can talk to a doctor, therapist, or medical expert anywhere you are by phone or video. They had over 10.6 million visits delivered by Teladoc health clinicians and therapists in 2020, and there's over 40% of Fortune 500 companies using Teladoc Health. They have over 11,000 care locations as of the fourth quarter in 2020, and there's 3.5 million visits enabled by the Teladoc platform solutions in 2020. There's also 540,000 people with chronic conditions that were served as of the third quarter in 2020. Now, of course, 2020 was a huge year for Teladoc, as the pandemic caused the demand for at-home visits to skyrocket. But they do say that their 2020 bookings position them for a strong 2021. Their bookings are up over 35% year over year, with multi-product bookings being 2/3 of their new deals and seeing an increased average deal size. On February 24th, Teladoc presented their fourth quarter and full year 2020 results. Their fourth quarter revenue grew 145% year over year, and their total visits increased 139%. For the full year, their revenue grew 98% year over year, and total visits 156%. One notable person that is also buying the dip in Teledoc is Kathy Wood from ARK Invest. 3 funds at Wood's ARK Investment Management expanded their stakes in Teladoc, seizing the dip on Wednesday caused by Amazon's move to offer its virtual doctor visit system to other companies. Teladoc shares dipped 4.4% on Wednesday on the heel of this announcement. The pandemic has materially accelerated the adoption of virtual care, said Simon Barnett, who is an investment research analyst with ARK. He said it's like trying to put toothpaste back in the tube. It's not something that's going to go back to brick and mortar as the pandemic abates. Covering the Teladoc stock for Canaccord is 5-star analyst Richard Close. He says that bright spots such as multi-product sales, increasing utilization, new registration strength, and visit growth in non-infectious areas trump the membership metric when all is said and done. Opportunities have presented themselves in the past to jump into or accumulate shares of Teladoc. We believe that this is one of those opportunities. Now, there are currently 21 analysts with ratings on the Teladoc stock, and it comes in as a moderate buy with 13 buy ratings and 8 holds. The average price target is $255 for about a 37% potential upside. Taking a look at our detailed list of analyst forecasts, the most recent comes in yesterday from RBC Capital, who gave the stock a buy with a $260 price target for just shy of a 40% potential upside. The highest showing here is from Credit Suisse with a $300 price tag for over a 60% potential upside. The second company that we're taking a look at is Agnico-Eagle Mines Limited. They trade under the ticker AEM and are currently priced at $60.67 per share, and they also pay a dividend, currently at a yield of 2.31%. Agnico-Eagle is a senior Canadian gold mining company that has produced precious metals since 1957. Its operating mines are located in Canada, Finland, and Mexico, with exploration activities in each of those countries, as well as in the United States and Sweden. The company and its shareholders have full exposure to gold prices due to its long-standing policy of no forward gold sales. Agnico-Eagle has also declared a cash dividend every single year since 1983. In fact, over the last 38 years, they've paid a cumulative $1.3 billion in dividends, and their dividend had seen growth of about a 27% compound annual growth rate since 2014. They've seen solid operating performance with record production in the fourth quarter of 2020 and record earnings and cash flow in 2020 as a whole. They expect 24% production growth from 2020 to 2024, supported by record mineral reserve. Gold production in 2021 is expected to ramp up over the year. Overall, 2021 gold production is expected to be split approximately 48% in the first half of the year and 52% in the second half. They also have near-term opportunities supporting their production growth in 2021 and 2023. Their Kittilä mill expansion was completed in the fourth quarter of 2020 ahead of schedule, and their Meliadine Phase 2 expansion remains on track. They also have their Amaruq underground project with gold production expected in 2022 and their Odyssey project with initial production expected in 2023. And they're also in a strong financial position. As of December 31st, the company had strong liquidity with $403 million in cash and cash equivalents and $1.2 billion in undrawn credit lines available. One analyst commenting on the stock is Anita Soni from CIBC. She said, in our view, the market reaction on the back of quarterly earnings was overdone, and we would recommend investors add to positions on the dip. We continue to favor Agnico for its track record of prudent capital allocation, largely organic growth strategy, exploration expertise, project pipeline, and strong management. Currently, there are 12 analysts with ratings on the Agnico Mines stock, and it comes in as a strong buy based on 9 buy ratings and 3 holds. The average price target is $85 per share for a 40% potential upside. The most recent rating comes from 5 days ago, and it's a hold rating from RBC Capital with a modest upside potential of about 8%. We do have a couple higher on there, one coming from 4.5-star analyst Jackie Przybylowski at BMO Capital with a $100 price target for nearly a 65% potential upside. And last but certainly not least, we have Redfin. Trading under the ticker RDFN, they're currently priced at $70.72 per share. Redfin is a real estate brokerage whose business model is based on a small fee of 1%. Their mission is to redefine real estate in the consumer's favor. They're the #1 most visited brokerage site with 4 times more traffic than the second largest brokerage website. And they have nearly $1 billion in customer savings since their launch in 2006. They have their Redfin brokerage where they list the home for you, Redfin concierge where they fix up the home and then list it, or Redfin Now where they just buy the home outright. They've seen consistent growth in both revenue and market share, with a 14% growth in revenue in 2020 and now holding 1% of U.S. market share by value of homes sold. 90% of listings appear on Redfin within 5 minutes of their MLS debut. They said 87% of home tours are scheduled automatically, and 65% of agents can write offers right from their phone. They've also expanded into the mortgage and title business. They launched Redfin Mortgage in 2015, which is now in 56 markets in 20 different states in the District of Columbia, and Title Forward, which was launched in 2012 and operates in 27 markets in 13 states and the District of Columbia. On February 19th, Redfin signed an agreement to acquire RentPath for $608 million in cash. They operate Apartment Guide, Rent.com, and Rentals.com. The acquisition will bring together the leading site for buying a home with the leading site for renting a home, giving anyone a more complete view of their options. Covering the Redfin stock for Wedbush is 5-star analyst Igal Arunian. He wrote a note on Redfin titled, "Buy the dip, there's a lot to like here." He says the strength in the housing market is continuing to drive material benefits to Redfin, where it is having trouble keeping up with demand. customers seeking service from agents was up 54% year over year, even after Redfin made changes to its site that discouraged customers from requesting tours when an agent was unlikely to be available. He added that Redfin still doesn't have nearly the amount of agents it needs for the level of demand it is seeing, and they're hiring aggressively to get there. Agent recruiting increased by 80% for lead agents in December and January versus September, October. Redfin is also seeing increasing repeat rates and referrals, which can support growth for longer. Redfin has 10 current analyst ratings on their stock, and it comes in as a moderate buy based on 4 buy ratings and 6 holds. The average price target of $87 is about a 24% potential upside. Our lowest rating on there is actually a buy rating, which now has a downside of about 20%. Our highest rating does come from Yigal at Wedbush, who gave it a $109 price tag for about a 54% potential upside. So there we have 3 stocks that analysts think could be a good buying opportunity during this recent dip. Now you guys know I always love hearing from you, so make sure to leave your thoughts in the comments down below on these 3 stocks, plus what other companies have been catching your eye as great buying opportunities lately. Please keep in mind that these videos are never a suggestion to buy or sell any specific stock and are just meant for entertainment and information purposes. Any investment decision needs to be made based on your own research and due diligence. If you made it all the way to the end of today's video, make sure you hit that thumbs up button and that you're subscribed to the channel as well. Don't forget to head on over to the TipRanks YouTube channel to catch my daily pre-market update Monday through Friday. Thank you guys so much for watching. I hope you have a fantastic weekend, and cheers.